It's sort of a committee. There's different viewpoints. There's the valuation committee and the sentiment committee and the sustainability committee, and they're each voting on whether we like this stock or not. Compared to our quant peers, we think it's okay to intervene, right? The quant model is not sacrosanct. The rationale for the contextual weighting is to say, let's not be dogmatic. Let's not say that every stock has to have a 30% value weight and a 25% sentiment weight. Let's have some baselines around which we vary that. Instead of just looking at the momentum characteristics of your target stock, identify its peers. And there's a number of different ways you could identify peers for a company and measure their momentum as well. And look at the weighted average momentum of those peers. We very much don't view, growth as the opposite of value. And that's why there's a little bit of an opportunity here to potentially use a factor. We're not trying to build a sustainability alpha factor that makes people feel good. We're trying to build a sustainability alpha factor that makes people money.
Hi, Joe. Thank you very much for joining us today.
Good to be here.
We want to have you on today to talk about your approach to factor investing that you deploy at Causeway, the components that go into a factor model that you have built. And I think there are some interesting and maybe a little bit what I would call unconventional or maybe unique factors that you guys look at, and sort of getting into those, pulling back the cover and just thinking about how you build portfolios using these factors, and a lot of other things, portfolio construction. Really, I think this conversation is going to be a lot about investment process and with an emphasis on factors. So we're excited to have you on. For people that listen to this that want to check out the strategies over at Causeway Capital, you can go to their website. It's causewaycap.com. We like to get that in right up front so that, the people that are listening to this can support the guests like Joe when they come on and spend their time with us. So again, Joe, thank you very much.
No problem. Happy to be here.
Yeah, I wanted to start, I was looking at your background, and it's not very often we get to talk with someone that has worked at NASA. And so earlier in your career, you were at NASA's Jet Propulsion Lab. And so I thought it would be fun just to hear about how that experience maybe shaped your approach to problem solving. And then, are there lessons that you that spill over from that over into the investing world?
Yeah, I mean, look, I personally think, having had a background in the physical sciences, I studied physics as an undergrad. I went to grad school for physics, ended up, focusing on astrophysics. Ultimately made a different decision about what I wanted to do with my life and with my career, but you sure do learn some good skills and problem solving and logic, and you learn a lot of math, more math than I ever use now. And so I've found it really useful, and I kind of have a soft spot when we're hiring quant analysts for, people who've got that sort of hard sciences or math background. You need the finance too. You can't just take somebody who's done that and drop them down into the research environment. They need to do the MBA or do the CFA or do something to pick up that finance and investing knowledge. But it really is a good platform. So a lot of times, I describe myself as a recovering astrophysicist, and I took kind of a long and winding path to investment management. I thought I wanted to be a scientist for a while. When I left astrophysics, I actually went and worked as a software engineer for a number of years. So I worked for big companies like Monster.com, worked for startups. And then I went to business school, got my MBA. I actually joined Causeway straight out of business school. And so, in retrospect, it kind of looks like I had this grand plan to say, let's get the math and the hard sciences and the analytical tools, and let's get the software development tools that you need as a quant. And then let's get the business knowledge. But, I didn't plan it that way from the beginning. That's just sort of how it turned out.
Causeway is known for sort of this fusion of quantitative and fundamental analysis. So you're really blending the two with some of your strategies. Where do you think fundamental analysis can add value sort of beyond a quant model?
Yeah. If I were to think about the strengths and weaknesses of quant versus fundamental, I think it comes down mostly to depth versus breadth, right? So if you're running a fundamental process, you have incredible depth of research and knowledge and understanding of a specific company that you're looking at, but it doesn't really lend itself to covering a huge universe of stocks all at one time. And so quant has this breadth advantage. And I think quant also has sort of a a dispassionate nature to it, a consistency with how it blends together different pieces of information. It's quant processes tend to be pretty good at managing systematic risk and understanding how those might be building up within a portfolio. And so our view at Causeway is there are strengths and weaknesses to each side, and we should try as far as possible in every strategy that we run to use the strengths and weaknesses of both quant and fundamental. Well, not the weaknesses, to use the strengths of quant and fundamental, to use them to supplement and kind of support each other and make each process a little better for having done that. So we have fundamental strategies at Causeway, mostly sort of developed market international strategies where the quantitative group is providing portfolio construction assistance, understanding of risk management, understanding of how systematic risks are cropping up within that portfolio. And then we have things like our emerging markets equity, our international small cap, our global systematic equity, where what we really want from the fundamental side is what we call a fundamental layer of risk control. And the idea there would be, I think quant processes are by and large very effective at finding opportunities within an asset class, getting most of the decision-making right about stocks. But there are times when they may be missing something really important about a stock. There's just the data, the information that feeds into the quant model doesn't capture an important dynamic. And so, an example we often use when we talk to clients and prospects is think about a pharmaceutical company that's got a clinical trial result coming out, next week. And maybe it's a company with a pretty small portfolio of drugs, small pipeline. What happens with that clinical trial result, whether it went well or went poorly, and what that implies about what's next for that drug, that's pretty much everything. That's the whole ballgame for that stock in the near term. And whatever the quant model thinks about the stock is probably going to be overwhelmed by the sort of binary news-driven nature of that event. And so we rely on our fundamental colleagues who know a lot of these spaces very well. They're specialized by sector. So if we have a pharmaceutical analyst who can warn us about a clinical trial result coming up, or a utilities analyst who can warn us about a regulatory review coming up, maybe a company has serious litigation pending, maybe there are other regulatory issues that the quant model is not aware of. We want that layer of risk control where somebody's sanity checked that position from a fundamental perspective and said, I see why your quant model likes the stock, but this may not be the right time to buy it.
What about the development of the quantitative aspect of your investment process over time? I mean, there's been, over the last 20 years, we've seen different market environments, different market regimes. We're in a different environment today than we were 12 months ago. And so how do you go about refining, evolving your quantitative process and sort of the testing that goes into that?
Yeah. So the way that we think about, testing signals in the quantitative process, we can get into this a little bit more later as far as the different sort of categories of inputs that we have. But imagine you've got, value-oriented inputs, sentiment inputs, growth, quality inputs. Each of those is a composite in and of itself of signals underneath that make up that category. And really, before something goes into the model, we need to look at whether it works, whether it's predictive of future stock performance. And so that would be doing your back tests, looking at, long, short, tile spread performance, looking at the volatility of that performance. And then at some stage, also looking at the correlation of the performance of that signal with other signals that might already be in the model. And so really what it comes down to is you want signals that work, that deliver return, that work as consistently as possible so that they don't have too much volatility, and also that are diversifying to what's already in the model. So it's a signal that works pretty well and has very low correlation with signals that are already in the model. That means that information is not yet represented fully in the decision-making process. That would also be attractive. So it's a combination of those things. And, what keeps you busy is that there are new sources of data coming online all the time. So, if we have access to a new type of data, that means there are new signals we can build from that. You've got to keep an eye on older signals and make sure that they're still working now as well as they had in the past. And sometimes you have to make tough decisions about, reducing the weight or eliminating older signals that are superseded by, things that work better. And then I think the really tough part of the judgment process is, when do you make those decisions about, reducing the weight of a factor? I don't think it can be totally mechanical. There is some judgment involved in that. And I'll kind of rewind you to thinking about, something we were all going through in the mid to late 2010s, which was what we call value winter around here. It was a time period where if you had the audacity to even care how much you were paying for a stock, you tended to get pretty punished by the marketplace. And so, there might be a tendency at a time like that, if you're just a pure number cruncher, pure black box quant, to say, well, I'm looking at the efficacy of value as a signal. It's gone down a lot over time. Therefore, I should reduce its weight in the model. And when you step back there and you use your judgment, your knowledge about what's going on in markets, that sounds like exactly the wrong thing to do. And in fact, it would have been exactly the wrong thing to do. The US is a bit of an anomaly, but we spend a lot of time in international markets, in small cap, in emerging markets, and value's been on an incredible tear for the last 3 or 4 years in those areas. If you had a process that mechanically underweighted value, sort of right at the heart of value winter, you would never recover from that.
I just like the idea that we actually can use the phrase value is on a tear in a podcast, because there was a very long period of time where we could not do that. So
Believe me,
I'll take the heart
too. We're not exclusively value investors, but we do have this idea that it should matter. The price that you pay for a stock, that there is an intrinsic value to it. So it's good to see that it's coming back.
So I'm going to put up on the screen the end result of this whole process you have, because it's interesting. When we talk to quant managers, we're often talking about the major factors, and we're going to do that here too. We're talking about value, momentum, and quality, maybe low volatility, but you have a lot of unique ones in here that I haven't seen from other people. So I want to kind of go through these one at a time and talk about how you think about them. And the first is value, which you just talked about. Yeah, but it's been a challenging thing, as you explained, to be a value manager, because there's been a lot of talk of, does the price to book work anymore? Do I need to account for intangible assets? Like the ways people built value strategies in the past, people have argued you have to change those or adopt those to the new economy. Yeah. How do you think about that? And how do you think about defining value?
Yeah. So we try to use a lot of different inputs within the value complex and fine tune them a little bit to the sectors that we're talking about. So, we have, first of all, I think kind of a vanilla book to price doesn't work terribly well anymore. But if you do, as you mentioned, if you do some refinements to them, if you do kind of a warranted multiple approach, which is something we've been doing a lot more of recently, which is to say, the correct valuation level for a company depends on some other factors. For example, if I've got a company that's delivering very high return on equity, I can support a higher price to book than for a company that's not, right? And that actually, in some ways, sweeps up the idea of intangibles as well. That high ROE, is very likely due to some intangibles that they have that are benefiting them. So we've modified our price to book factors to use those warranted multiple type approaches. We're looking at other warranted multiples, like obviously, growth is an aspect of that might justify higher multiples in some cases, quality of management, the level of business risk that you see within an operation. Those are all kind of other kinds of things that you could do to further refine that. But on top of the price to book, we're using, cash flow yields, what we call payout yield, which would be dividend yield and share buybacks, earnings yields, EV to EBITDA. We use a whole range of valuation measures. And the idea being, if you can find a stock that looks cheap on a bunch of these simultaneously, that kind of increases your confidence that you found a cheap stock. Another thing that we do, maybe a little controversial, but we find it effective, is we look at sell side target prices, and one of our value factors is what we call kind of a price gap or a target price upside. If you took the consensus price target for a stock and said, what expected return does that imply? What's the alpha for that stock? So it's not the only piece in the valuation model, but it rides alongside these other things, because the challenge, I think, sometimes with forward earnings yields and forward, EBITDA to EV measures is that we only have, maybe a year, 2, maybe 3 years forward of measurements from sell-side analysts that we can use for those. And especially when you're going through something like COVID or something where the near term has been really disrupted. And so, maybe earnings are challenged or cash flow is challenged in the near term, but longer term, on a longer duration basis, those longer duration cash flows may be okay and they may be set to recover. you can generally capture some of that with that target price upside type factor, because a lot of these models may be DCF based, or, using things that look a little further out.
How about sentiment? That is a pretty unique one among managers. And I think it's probably going to get back to what you said earlier in terms of looking for uncorrelated factors with the other factors. But can you talk about why you use that and how you measure it?
Yeah. It's interesting. You start to get into nomenclature with some of these factor categories, because a long time ago, we used to call what we currently call sentiment, we used to call earnings growth. And that, maybe sounds less controversial as a factor category. I think, we do have some peers who use that category as well. But what we found over time is that there are a lot of things that were going in there, and they all basically had one thing in common, which is that they were things that we were using to predict earnings momentum over the next 3 to 6 months, where we wanted stocks where we thought we were going to see really positive development of earnings over that kind of a time period. And so the things that go in there are things like, sell-side analyst estimate revisions, estimate diffusion. We use things like earnings announcement return in there, but we're also using kind of newer things like, NLP-based earnings, conference call, transcript, sentiment. So we have a factor we've developed that assesses sentiment for those earnings calls using different NLP techniques. And so that goes into the sentiment complex as well. We have something that we call analyst relative ideas. And the concept there is to sort of figure out, when you look across the community of sell-side analysts, which stocks tend to be kind of a favorite or a least favorite for a broad range of analysts. And it turns out behaviorally, in terms of their incentives, what they're talking to people when they go out and talk to the buy side, that has an impact on future performance for those stocks.
Yeah, it sounds like you guys are big believers in composites versus trying to figure out, which factors are the best within each space.
Absolutely, because I think you just don't know that one single factor is always going to capture the full dynamic for value or sentiment or any other category. So we really like to build up composites within these categories.
So how about the next category, technical? Is that what what a lot of factor investors would refer to as momentum? Is that what you're doing inside there?
Yeah, it's mostly momentum. Well, I guess what I should say is it's 50% sort of traditional momentum on, say 6, 9, and 12-month timeframes. And then it's 50% what we call network momentum. Some people might call it linkage momentum. And that idea being that instead of just looking at the momentum characteristics of your target stock, identify its peers. And there's a number of different ways you could identify peers for a company and measure their momentum as well. And look at the weighted average momentum of those peers. And then that becomes a network momentum score for your company. Why does that work? The reason it works is that market information diffuses into different stocks at different rates. So a lot of times the bigger, better covered, better known stocks that are more popular with investors in the market, if you have information on those, it'll diffuse fairly quickly into the stock price. But there may be related companies who are competitors, companies that are in its supply chain that the market doesn't know as well or cover as extensively. And the information, good news or bad news, will diffuse into those stocks at a slower rate. So one thing that you can do is, if you understand who the peers are and if they're receiving good news or bad news, eventually that news will diffuse into your target company as well. But this is kind of a way to get a little bit of a head start on where the momentum of the stock might be going in the future.
Yeah, I've seen some research to back this up too, and it might be a little bit of a different concept, but this idea that when a stock's momentum is backed up by its industry momentum, that's more predictive of the future.
Yeah, I mean, and that's exactly what this would tend to do, is say, okay, if we've got a model that's 50% stock-specific momentum, let's verify that that's happening for our stock, and then let's verify that there's good information, within that industry or within your peer groups. And we have a number of different ways to define peers. So we do, competitors, we do customers. We look at companies that are covered by the same sell-side analysts. They tend to be sort of grouped into logical units. And then we have kind of an NLP-based method where we're looking at earnings, conference call transcripts again, but instead of trying to get at sentiment, we're looking at those transcripts to try to classify which companies are related to each other, which companies are talking about the same challenges, the same opportunities, the same issues that they're confronting. maybe talking about similar technologies, whatever the case might be. And you get another interesting view on peer groups from looking at that, things that, that end up being really kind of insightful. We had a company we were looking at a while back called Clear Secure. And when you look at the peer groups for that, it's really hard to classify what that company is. I don't know if you guys know this company, but when you're at the airport and they've got the retinal scanner to get you through the security lane faster, that's what they do. Nominally, they would be classified as a software company, but they're kind of a travel company and they're kind of a security company. And there's a lot of things mixed together. And when you run this transcript-based classification, it does the right thing. It starts saying, well, some software companies are its peers, but companies that do background checks are its peers, and airlines are its peers, and companies that operate airports are its peers. And I found that really interesting and compelling, that it could find those kinds of relationships that other peer group relationships wouldn't find.
This next one is growth is interesting because this is something you don't see a lot of factor investors use. And part of that is because in the academic research, they sort of just classify it as the opposite of value. So growth is just buying expensive stocks.
Yep.
But I assume you're looking at it in a different way than that.
Yeah, we very much, that's a good qualifier. We very much don't view, growth as the opposite of value. And that's why there's a little bit of an opportunity here to potentially use a factor. Now, is there a correlation? Absolutely. If you're to sort of take a two-dimensional plot and plot value versus growth, there's some clumping. So a lot of times, stocks fall at the opposite. A value stock may not be a growth stock, but there are exceptions. And those are the exciting exceptions that you want to find. A stock that the market doesn't really appreciate, hasn't put on the right multiple, but, that potentially does have good growth characteristics. It's also kind of, going back to what I said before, it's a bit of a warranted multiple approach. If you have a model that uses value and uses long-term growth together. And by the way, that's looking at, trailing growth and then forward expected growth according to sell-side estimates. It sort of gets you a better answer on value. It allows you to say, look, some stocks they're allowed to trade at slightly higher multiples if we're seeing, good growth in there. So we shouldn't, if I have two stocks that are trading at 20 times forward earnings and one of them's got great growth and the other one doesn't, this model would differentiate between the quality of those opportunities.
And I think it's a lesson a lot of us that are value investors learn with the Mag 7, which is, these were companies that maybe traded a little bit premium multiples, but what they were worth relative to what ended up happening, they were actually very attractive values.
Yeah, exactly. And so it really does create a better ability to navigate that kind of thing. So we think it makes sense. And we do often see people asking the same question that you're asking. It is a bit unusual. The other thing is especially when we do not just sort of univariate performance analysis on the factors, but if we do simultaneous multivariate Brinson attribution on the factors, it really starts to show up as being even more effective than it looks in a univariate context. So what that's telling you is that the way it interacts with value is making it work better.
This next one, quality, is, I think, hard to define for your average person, but even hard to define for factor investors. This is probably where I see the most dispersion in what factor investors use. So, people say, well, if Warren Buffett owns it, that must be quality or something like that. But when you get into what it actually is, it's hard to come up with it. So how do you think about quality? Yeah,
I think you're right that if you were to go across many, many different investors and line up their quality scores, there's so much variety, more so than any other category. We think of quality internally. A lot of times we call a bunch of our quality factors competitive strength. And so maybe that's a little more evocative term, because when we initially developed our quality factor, we were thinking of sort of a Porter's 5 forces type of approach, where you say, what do I think of the industry that you're in? Is it attractive? What do I think of your position within that industry in terms of market share and defensibility and things like that? So it ends up having a lot of information about margins and profitability and your position within the industry that you operate in, and whether that's an attractive industry. So that's sort of part of the equation. And then there are some more sort of balance sheet, financial strength oriented factors in there as well. So it's a bit of a combination of those two concepts.
Yeah, we had Steve Romick on the podcast, and he was talking about this idea that he feels like these days quality is more in the actual business than in the balance sheet. He feels like maybe we've shifted a little bit more towards and you see this in a lot of the companies that have really consistent earnings, and maybe even some of the tech firms. So he had felt like it shifted that way relative to history.
Yeah, I think it's very important to look at that quality of the business aspect of things. We do a lot of small cap investing, and so we're still pretty sensitive about the balance sheet part of it too. These are companies that may not have the same access to capital, debt financing, equity financing that other firms would have. So we do want to make sure they're pretty solid on that front as well. But yeah, I would say certainly, using both makes a lot of sense.
This next one's completely unique, I think, in terms of what I've seen for other factor investors. What is corporate events?
Okay, corporate events is, I'll give you a little bit of the history here of why this sort of even needed to be a factor. But I guess before I get into the history, I'll tell you a little bit about what's in it, and then I'll talk to you about why the factor had to be constructed this way. Corporate events has things like, significant management changes at the CEO or the CFO level, particularly if they're sort of disorderly changes. It has debt financing, equity financing events, late filings, changes in dividend policy, changes in share buyback policy. And the idea is that, as I mentioned at the outset, we're always sort of talking to our fundamental colleagues to say, hey, what should we know about this stock that, maybe the quant model loves it, but maybe there's something happening right now that's going to kind of interfere with that thesis. And one of the things that we found as we went through this research is, yeah, if you've had disorderly C-suite management changes recently, it's hard for the market to really get on board and move forward with this stock. If you're, all else equal, if you're raising a lot of equity capital or a lot of debt, it's hard for the market to get on board with it because it's worried about those things. These are things that may hold the stock back. And so historically, we've gotten some of that kind of information from our fundamental colleagues, but it's really nice to have access to a database of information where we can pull all these events in and make sure that we've taken those kinds of overhangs into account. And one of the things that I think is really interesting about this factor is that most of these things are very low breadth. And what I mean by that is, if I look across a universe of thousands of stocks, at a given point in time, how many of them have recently had, a disorderly CEO change? Probably a very small number. And so as quants, we don't like to use signals where, most of the stocks that we score have a 0, and then a few of them have some kind of an interesting score at a given point in time. And we came up with this idea, and we always encounter factors like this. When you look at, insider buying and selling activity, CEOs or CFOs buying or selling shares in a company, you get this low breadth issue as well. And when you talk about some of the other events that I talked about, you get this low breadth issue. But our insight was, well, why don't we take each of these events, we'll do event studies on them, and we'll figure out, A, is there some drift, right? Does the market see the event, and then does it immediately digest all that information, in which case there's not a factor there? Or does the stock price sort of drift in a certain direction meaningfully for months thereafter? And we started from a database of a couple hundred events. We threw a bunch of them out because we just didn't have a prior on what they should or shouldn't do. But we tested a bunch of other ones to say, okay, is there a post-announcement drift on this factor? How strong is that drift? And does it match our prior assumption about what should happen? And for the 20 or so factors where that was true, we now effectively give each of them a coefficient, a weight based on how strong that post-announcement drift is. And we start to stack them up. And when you stack them up and you add them up on top of each other, you take all these individually low breadth events and you end up with a factor that has good breadth, where some of these things are happening across this universe of stocks. Maybe one or two of these things is always in the radar for a given stock that you're looking at.
This might be wrong, but would it be fair to look at this as kind of a negative quality score?
Yeah, it is. That's a perceptive observation, because it is mostly a negative thing. There are some things like, if we see stocks that have increased their share buyback or improved their dividend policy, that can push things to the positive side. But this does skew a little bit to the negative. And one other thing I'll tell you about this that's interesting is we learned 90% of the time the event follows the prior that you have. Like, I'll give you an example. You have a company that is issuing equity. When you run the event study, most of the time that's going to prove to be a negative event, all else equal, that the market isn't going to love. But let's say you have a company that is, it's distressed, the balance sheet is in trouble, people are sort of worried about the viability of that company going forward. If they just bite the bullet and issue equity, the market is relieved. They say, okay, good, you can fix up your balance sheet. I'm not thrilled that we're raising equity, but we're fixing the balance sheet problem, the market might actually have a very positive response to a stock like that. So we realized as a refinement to a factor like this, you need to sort of go back through and say, we can have our prior about each of these events and how much weight it should have, but we're also going to observe what we call an earnings announcement return in a 3-day window around that announcement. We're going to see if the market responded in the way that we expected it to, or if it did the opposite of what we expected it to do. And then we're going to amend that weight for the individual event based on, whether the market followed our prior or not. If the market really aggressively did not follow our prior, we just effectively revised the weight of that event down to 0.
Does any specific examples sort of come to mind where this kind of, propped up on these negative events, like any specific company examples? Like, 'cause what you said before about sometimes these quant models, the companies look great, but like underneath the surface, there's a lot of issues. And it got me thinking too, and it probably wouldn't have been the case in this example, but like back in the mid 2000s with like the for-profit education companies. And, like quant models, those were looking like,
oh yeah,
great.
Loved them.
But then they just got like completely obliterated. Now, I don't know if any of those signals would have identified that, but that's what it got me thinking of as an example.
Yeah. Well, I will say that's one thing that we were able to benefit from through that fundamental review that I talked about, that fundamental layer of risk control. We during that time, just like you said, our quant models loved the not-for-profit education companies. They looked super, super cheap. And we had fundamental colleagues who were looking at this and saying, you got to be careful. Like when we think about what the Chinese government wants right now, they do not want this. This is not within the range of activities that they want to see happening. And it doesn't matter how cheap it looks. So I think that kind of thing is important. And it's interesting that you kind of tied that together, because I think the corporate events factor is what can we do systematically to identify those kinds of overhangs? And then additionally, we have that channel of input from our fundamental colleagues that kind of helps to keep us out of trouble with things that other quant processes might just go for hook, line, and sinker.
It'll be interesting as technology evolves. I would assume the quant process will be able to do more and more of what the people can do right now, probably.
I think that's true, especially when you look at Gen AI and you look at the ability to consume text information. I mean, to me, one of the game changers about that is that as quants, we like numbers. There's a lot of interesting text and people are writing all kinds of things about different stocks. But as a quant, historically, very hard to use any of that information because it's not a number. You can turn that information into a number that a quant model can use. So I think that's potentially very disruptive.
How about the last factor, sustainability? How do you think about that?
Yeah. I mean, look, this is an area that's had its moods over time, over the last 4 or 5 years. People were really enthusiastic about it a while back and not as much now, unless you go over to, Europe or Australia. They're still kind of enthusiastic about these things. Our test has always been, does it add to performance? We're not trying to build a sustainability alpha factor that makes people feel good. We're trying to build a sustainability alpha factor that makes people money. And so we have this concept of materiality, which is you can look at the whole range. If you look at MSCI ESG scores or other vendors that have ESG scores, they have hundreds and hundreds of different categories of information that they look at. We've fine-tuned that down to the things that we think are material to investment performance, and that's what the model is built from. And when you think about something like G, it's not that controversial to say governance should matter. When you make an investment, again, the stock could be really cheap. We could love the sentiment. We could like the momentum. If we've got a garbage management team or a garbage, governance structure around that company, that's not necessarily going to end up being a good investment. So, we think the G stuff is pretty uncontroversial. And then, what you end up with in E and S is, again, if you're focusing on things that are material to investment outperformance, you can build a factor that works pretty well. Is it, look, our factors are not created equal in terms of how much alpha they can add over time. I think the big ones are value and sentiment have the biggest return potential, and they're therefore on average get the most weight within the model. And then there's kind of a second tier of things like the long-term growth and technical and the sustainability factor that, I'm not proud. If there's something that can add additional alpha on top of what we already have, I'll take it. If it's 20 or 30 basis points of extra alpha per year, happy to take it.
And I think the market's come around to your view of looking at ESG as more of a performance thing, because I think one of the problems with traditional ESG scores is there were a lot of things in there that just clearly were not going to positively impact performance over time. If you wanted to invest that way, that's great, but you had to understand they were kind of being sold as we're going to give you better performance with these things. And I think maybe looking at just the things that actually produce better performance might be the way we're going forward with this.
Yeah, I think so. I think there are different clienteles for sustainability investing. Some investors want that values approach, and they can find managers who give them that. We want to add value through material ESG factors, and so that's what we do.
So I want to talk about how you combine them because you've got a really cool system. But before I do that, I just want to talk about the general ways you can combine factors and how you view those and what you use. Because there's basically two approaches. If I think about just value momentum, some people will say I'm going to use the sleeve method. I'll have my value stocks on one side. I'll have my momentum stocks on the other side. I'll just create 220 stock portfolios. I'll put them together into a 40 stock portfolio. That's how I do it. And others will look at a composite score.
Yep.
Which is, I know how you do it. So how do you think about the trade-off between those?
Yeah, they can both work, and we've observed this over time. There are different market environments where one approach or another works better. I think my view is that on average over time, that composite approach is what's going to work better, and it resonates more with me philosophically because I view those 7 factor categories that we have in the model. It's sort of a committee. There's different viewpoints. There's the valuation committee and the sentiment committee and the sustainability committee, and they're each voting on whether we like this stock or not. And you don't have to have a unanimous vote, for a stock to get into the portfolio. You can have situations where, maybe a stock is pretty decent on all 7. You would definitely get into the portfolio in that case because it's very hard for these uncorrelated factors to all kind of line up in the same direction. That would be a high score. But other ways to get high scores are just to have a stock that is, that is maybe a very good growth story. Maybe it's a little bit expensive. It's moderately expensive, right? So it's being penalized by the value factor, but it's getting a much more of a boost from the sentiment and the growth components. And so it still ends up being a good stock. But what I want to protect myself from is the case where that stock becomes very, very expensive. And now I've got, maybe a very high sentiment score and a very negative valuation score. And in a composite, those sort of cancel each other out. And in a universe of, our global strategy has 6,000 stocks in the universe. If you're getting canceled out in a big way by one of these factors, there's some other stock out there that doesn't have that problem. That either looks pretty good on all of them or looks really good on a few of them and doesn't look terribly bad on any others. It's a very competitive universe, and I'd rather have that potential, for the interaction between factors in the model. It makes more sense to me.
Before we talk about how you build your model, I wanted to ask you in general just about this idea of fundamentals mattering less, because one of the things we've talked about a lot in the podcast is the rise of passive investing. And passive flows are just going into the biggest companies, more is going into the bigger companies. David Einhorn's talked recently about the idea that when he operates in the small cap space, people are just ignoring all these companies now because they're not even in the passive indexes. Mike Green's talked about the idea that, the bigger companies are being driven up relative to the smaller companies by these flows. Do you have any opinion on that?
Oh, I mean, it definitely creates huge distortions. It's something that we all have to try to navigate. I don't think it makes it so that the fundamentals don't matter, but I think what it does is it creates a potential for bigger dislocations. And what we're all doing obviously is searching for market errors, mistakes, dislocations. I think sometimes those dislocations can run farther and longer than they would have otherwise because of passive investing. Because you're at the point where active investors are almost outnumbered. And there's so much flow and so much decision making that's just based on the mechanical. What are the stocks that are big? That's what's going to get the most benefit from flow coming into a particular asset class. So, but I guess I take solace from the fact that it means the errors are still there, the mistakes are still there. And we may have to be a little bit more patient about it, but we're going to get a chance to clean those up and earn money for our clients by exploiting those mistakes.
So I'm going to throw this chart up because what you guys do in terms of your factor weightings is actually very interesting. You'll see a lot of firms that will have pretty static weights between the various factors, but you are sort of classifying companies along dimensions and then deciding what those weights are going to be. Can you talk about how that process works?
Yeah. So we call this our contextual weighting approach. And the idea is, I guess, to just at its core understand that there are clientele effects in investing. And what I mean by that is there's a whole group of investors who like value stocks, and there's a whole group of investors who like momentum stocks or growth stocks. And they look for different things. They care about different things when they make an investment. And the group of people who like stocks and follow them and pay attention to them, they're the marginal buyer and the marginal seller for that stock. And, you don't have to think too much about the economics and the stock market dynamics of it to understand that the marginal buyers are the ones who are going to move the stock. An example that I use for people a lot is to say, if I find a stock that trades at 25, 30 times forward earnings, I've had to revise that number up over time to make it sound expensive because markets have just kept lifting multiples up. But let's say it's 30 times. Value investors, it's not coming through their screens. They're not looking at the stock. They're not thinking about buying it. They're not building models. They don't have a price target. And therefore, if that 30 times forward earnings stock suddenly trades down to 27 times forward earnings, that's a 10% reduction in its valuation level. It won't affect their behavior at all. They're still not interested. It doesn't come through into their universe that they look at. But there could be a growth investor who looks at that stock and says, yes, it optically looks a little expensive, but I love the growth story. It's going to grow into that multiple. I have confidence in the stock. What are they going to be looking at? They're going to be paying excruciatingly detailed attention to what happens to the near-term earnings growth, earnings momentum, what's happened to the profitability of this stock over time. And those things in that growth and momentum kind of category will be very impactful. Sentiment, growth, and momentum will be very impactful on how they feel about the stock. And so the rationale for the contextual weighting is to say, let's not be dogmatic. Let's not say that every stock has to have a 30% value weight and a 25% sentiment weight. Let's have some baselines around which we vary that. And if we find a stock that we think is really interesting to growth investors and less so to value investors, maybe we revise that value weight down closer to 25. We give some of that extra weight to the sentiment and the momentum factors. And what it allows you to do, is participate, as one example, participate in these interesting growth stories, right? You talked again about like the Mag 7 and how do you navigate that. If you have stocks like that where you've said, we're willing to downweight value a little bit and upweight sentiment and momentum a little bit, that allows you to be more receptive to stocks that, maybe look somewhat expensive, but have these great growth stories. But keeping the value weight in there still at a meaningful weight. Let's say value still has a 20% weight. At some point, egregiously expensive companies are going to get highly penalized by that value score, and they're still not going to be able to get into the portfolio. But I think we do a better job navigating opportunities the way we've done it. It's kind of analogous to something that a lot of people do, which is they might say, hey, I think information technology is a growth sector. And so I'm going to give more weight to growth within that sector. Or if you're thinking internationally, hey, maybe I think India is more of a growth than a value country. And therefore I'm going to give more weight to growth in that case. Take the information technology example. It mostly works. It's on average, even with our process, on average, it's true that your typical IT company is going to see its value weight downgraded and its sentiment and technical and growth weight upgraded by this process. But there are segments of the information technology sector, commodity components, people who make capacitors and, things like that technically fall within information technology, but they're not growth companies in the minds of these go growth investors. They're probably interesting to some value investors. And so this process basically gets it right, even within sectors, the way that it's sort of a blanket sector approach wouldn't.
So the general idea is I would rate each stock according to each of the three dimensions, and then the weight of valuation would be the average of those three different weights or three different scores. Is that kind of the way I think about it?
Yeah, roughly speaking, the idea is to sort of create these three dimensions, which sort of look like the screens that type of investor might use. So the value dimension looks like a value investor's screen, and the growth dimension looks like a growth investor's screen. They're not our alpha factors. They're our assessment of what the screens for that group of investors looks like, how you kind of get inside their head. And then, what most quants do when they estimate weights for factor categories is they say, let me take the whole universe of stocks and let me estimate what's the right value, growth, momentum weight across this full universe. What we do instead is we say, for the value, the high value context, the cheap stocks that are very interesting to value investors, we're going to re-estimate our weights just within the 20% of stocks that are at the most extreme end of that value investor's screen. And that gives me a different population of stocks and therefore sort of a different back test and a different set of weights to the different categories. And then we're going to do the same thing across the other dimensions. And then, as you said, sort of blend it all together based on where the stock falls on each of those dimensions.
It's definitely interesting. We've talked to a lot of different factor investors, and I think this contextual aspect is something that I've never seen. I think it's pretty neat, pretty cool.
Yeah, we're big fans, and you know, it has times where it works better. More often than not, I think it works better than the one size fits all approach. And so yeah, we continue to have a lot of conviction in it.
As we get towards the end here, let's talk a little bit about risk and some of the other stuff you guys are working on. But you had mentioned at the outset that the risk management, the risk models are that's the other side. It's not just stock selection, building portfolios. It's using these quantitative models for risk management. So just talk about the factors that go into your risk model, and also, is the model set up to try to predict future profitability or future volatility, excuse me?
Exactly. Yeah, it's set up to be predictive for, future volatility or tracking error or beta, whatever the risk measure is that we're interested in at a given point in time. The model looks in some ways similar to what you might see from like a Barra or Axioma fundamental risk model. But what we've decided is, risk management is so important that we want to build our own, because if there's a factor that's not represented in one of these commercial risk models, we want to be able to build it into our process. And so one factor that we have that you don't generally see in these commercial models is a cyclicality risk factor. If you use value in your process and it affects the types of stocks that you're going to buy, sometimes you will be drawn to more cyclical stocks at certain points in the cycle. You want a risk factor that correctly measures that type of risk. So that's one example of being able to put a factor in that you think is important to your investment process. Another thing is you want to be able to estimate that model over the specific universe of stocks that you invest in. So we have a separate risk model for our emerging market strategy, a different model for our small cap strategy. And you can imagine cases where, maybe the value risk factor or the growth risk factor is behaving differently in the EM universe at a given point in time than it is in the broad large cap universe, or than it is in the small cap universe. If you have a big, huge model that's sort of simultaneously estimated over that huge universe, you can't pick up those risk dynamics in the way that the risk model works. And so we've built the risk model we think is sort of the exact right risk model for what we do. And we think it's worth putting the investment of time and energy into doing that. But to answer your question about the types of factors that are in there, generally we have style factors like value, growth, momentum. I mentioned cyclicality, size, is a factor that would go into the style category. And then you have a lot of factors related to geographically, where is the company, what currency is it exposed to, what sector or industry group is it in, and those in aggregate end up being the risk factors. And so, when you build these models, you don't want to look at historic stock returns and volatilities and correlations with other stocks. You want to say, what are the stock's risk exposures right now? And then you want to abstract that out to a set of factors where you can analyze the returns, the volatilities, the correlations of factors over time. Those are more stable. You're always looking at what's the stock's exposure to these factors? What does that covariance matrix of factor volatilities and correlations look like? And when I put a portfolio's set of exposures together and combine it with that covariance information, you can make a risk prediction for, again, tracking error, volatility, beta, whatever the case might be. But it's forward-looking in the sense that it says, what are you exposed to now, and what does that mean for your risk going forward?
Is there any risk metric that just stands head and shoulders above the rest to you?
Well, definitely, kind of like I said with the alpha model, there are different tiers of risk factors. And so within those style factors that I mentioned, there's a risk factor called the volatility factor, which is a little bit confusing because we're trying to measure volatility. But it's looking at stock betas, recent return volatility, what range the stock has traded in over the last 12 months, what's the sort of high to low range. That ends up being the style factor that explains the largest amount of risk. And it's very responsive. It can change sort of quickly over time as the stock enters a different volatility regime. Other things in that top tier are things like value and cyclicality. Those end up being pretty important in terms of explaining risk. And then obviously when you get down to things like the country factors and the sector factors, those are also pretty important to explain risk.
How do you guys think about portfolio size and sort of balancing the number of holdings with your factor exposures?
Yeah. Yeah. Again, this ends up being a big area of debate too. And if you look at quant investors, you'll see them falling kind of all over the spectrum on this. I would say we probably fall a little bit more towards the concentrated end of the spectrum. In other words, we'll probably have typically a smaller number of holdings in our quant portfolios than you might see for your average quant. And I think there are a couple of things that go into that. One is sort of a philosophical thing. If you think of the distribution of alphas or expected returns for a stock, for stocks in the universe, it's probably going to be sort of a normal distribution where there's a bunch of stuff clumped up around zero in the middle. There's a bunch of negatives on the left tail. There's a bunch of positives on the right tail. And so you'd like to get the highest possible expected return, go as far out as you can on that right tail. But the further you go out, the fewer and fewer stocks you have available that meet that very high level of expected return. And if you're just trying to stay way out there in that right-hand tail, you may build a portfolio that doesn't have enough stocks to be diversified. It won't be diversified across countries or sectors, or won't have enough individual stocks to diversify idiosyncratic risk out of the way. So to me, it's a trade-off. You're trying to find that sweet spot where, take our global systematic equity strategy. We have a 6,000 stock universe, and we're holding in the neighborhood of 150 stocks. That puts you way, way, way up in the top percentile on that curve. You're dealing with the most attractive, most interesting stocks. But when we look at it from a risk perspective, we say, yeah, with 150 stocks, I can still be very well diversified across countries and sectors and different risk factors. And I feel very good about this risk level. So that's what goes into it for us. The other thing that I think enters into it for us is that we have that fundamental layer of risk control. We've got fundamental people sanity checking these positions. And so we maybe feel a little bit more comfortable being more towards that concentrated end of the spectrum compared to where other quants would be who maybe don't have access to that fundamental review.
What is your approach to rebalancing? And I guess specifically, if you can talk to that, but then also there's obviously some type of self-discipline that comes in here. So can you just explain that?
Yeah. So if you think about our portfolio construction process, it essentially is take all of these expected returns for thousands of stocks, put all of their risk information in as well, identify the constraints that you want to put on the process. How much active exposure are you willing to have in each country or sector or individual stock? What level of tracking error are you comfortable with? And then run that through an optimizer. The optimizer says, okay, you tell me how much return is worth to you compared to risk. You tell me what your constraints are. I will scan this information and I will figure out what is the ideal portfolio to use. And so really what that means is that every time you run the optimization, every stock is competing to keep its spot in the portfolio. If it does not, provide something useful to the optimizer in terms of its expected return or what it can do for the risk characteristics of the portfolio, it's going to get pushed out. And so that's the sell discipline. The sell discipline is that, if a stock can't compete for its place in that portfolio anymore, it's going to get pushed out. The way that we trade is we actually run these optimizations every day. And we run them at different levels of turnover. So you might have a strategy where your goal is on an annualized basis to maybe have, call it 95% turnover, right? So you're going to be in the neighborhood of 8% per month. But that's not the most efficient way to use turnover. You don't want to put a date on the calendar and say, okay, I trade, the fourth Friday of every month and I do 8% turnover. And that's how I freshen up the portfolio. What you really want to do is say, every day I'm going to run that set of optimizations, and I'm going to do it maybe at 2% turnover and 4 and 6 and 8 and 16 and 20. So you do some smaller things than what your average level. You do some things that are larger than your average level. And then you look at the portfolio that comes out of each of those levels of turnover, and you assess how much alpha or expected return increase am I getting per unit of turnover that I spend. And the place that you want to be is, where that ratio is high. So that it might be that your portfolio needs to use a lot of turnover at a given point in time to kind of get out of a local minimum that it's in and get to a better place in this optimization space. Then that would call for a very large turnover trade. Or it may be that the most effective thing you can do today is just do a 2% turnover trade, just freshen things up a little bit, and don't really get too active in the portfolio. Or most of the time, the answer is don't do anything today. There's nothing compelling enough today where your alpha would increase enough to potentially offset the trading costs and the market impact that you would have from trading. So that's the constant assessment that we're making every day of, are there good enough trades out here that we should expend turnover to pursue them?
Well, what's neat about that is it's like a dynamic approach so that if the opportunities are arising in the market, I'm kind of thinking like the COVID.
Yeah.
I don't know specifically what happened, but
Yeah.
hopefully your system was kicking up. Like there's way more opportunities here, even though that was obviously big uncertainty, but
Yeah.
that ended up being a good time to rebalance into. So you guys probably were trying to take advantage of that.
Yeah, we kind of have a monitor that we look at, which is what's my best alpha increase per unit of turnover available today, and how's that look compared to recent past? And just as you mentioned, when we went through Liberation Day and the aftermath, sort of trade war implications, there's a lot of volatility. There's a lot of churn. There are a lot of opportunities being thrown out. And what we did is we said, we're going to trade a little bit more right now. We're going to do some of these smaller trades more frequently because we're seeing huge alpha increase per unit of turnover numbers right now. And we want to take advantage of that.
It's always cool to have guys on that are doing things with AI and incorporating sort of new, AI processes in your investment process.
Yeah.
And you sent over a couple of charts here. I'll just, we're going to put these up on the screen,
Okay.
but this first one is, you have your feature value on your right-hand side, and then you have a bunch of, I think, factors probably,
Yeah.
your G rank. And so can you just
Yeah.
talk to what we're looking at?
Yeah. I'll talk you through what we're looking at there. This is something that we've developed recently, which is, we talked about quality before. These are all quality factors in there. So there's, net debt, there's margins, ROA, financial strength. And we have a linear quality model that we all kind of talked about before, which has different weights for each of these factors, and then says, okay, your final score is going to be some weighted average of these scores on the linear factors. But we've realized, particularly for quality, this is kind of a non-linear type of space. And so if you look on that chart, for example, there's a net debt item that you can see on there. And one thing that you'll see about that is that it's sort of asymmetric. There's what the chart is telling you is that having a lot of net debt can be a very bad thing, but being kind of on the other end of the spectrum and having low net debt or even being very net cash, there's a point at which that stops helping you anymore, right? And so that's why when you look at that row, it's kind of got a longer tail on one side than it has on the other. It's capturing that insight effectively. This was built with a machine learning model. It was basically, you feed all of these quality factors into a tree model like an XGBoost or a random forest, and you let it figure out what the interactions between the factors should be. And they can be asymmetric, they can be nonlinear. You can have situations where there's an interaction. Another thing that we found when we look at this information is that you might have, net debt being, all else equal, if net debt is high, that's a bad thing. But if we have stocks that also have poor financial strength, and so in that case, that's sort of a cash flow measure. We're just making sure that once we've taken into account your operating cash flows and your capital expenditure requirements, that looks like that's in a healthy range. Well, if I have a stock that has very poor net debt, high net debt, and then at the same time, it also has poor financial strength, then the model is really going to sort of put those two things together simultaneously and say, okay, I really hate this stock from a quality perspective more than it would just from saying, I don't like your net debt or I don't like your financial strength. Does that kind of make sense?
Yeah. Now that I'm seeing the visual and you're talking through it, it does make sense. Yeah.
Yeah.
That's pretty cool.
And one of the things that highlights is that we've spent a lot of time developing tools to say, we need to be able to have transparency about why a machine learning model likes or dislikes a stock. We have a fiduciary responsibility. We're putting people's money at risk. It can't just be kind of this inscrutable neural network where we have, it tells us what to think about a stock, but we don't know why it thinks that. We've had to get ourselves comfortable with it. We've had to invest in these kinds of visualization resources where we can say, I can look at that as a portfolio manager and say, yeah, that makes sense to me. I understand what it's doing, why it's doing it, and it's weighing and measuring it very precisely in a way that would be hard to do without the assistance of the machine learning model. But we're not just kind of viewing the machine learning stuff as a black box that just sort of tells us what to do.
And I think it kind of shows like when you look at these things, like the word continuum might not be the right word, but how you have like this range of outcomes
Yeah.
and, and these clusters, I guess, to some extent.
You have this cluster. Yeah, exactly. Yeah.
And what about the next chart, which is do you have it up? It's the financial strength and the gross margin where you're plotting both
Yeah.
on the same chart.
Yeah. So the main thing that I wanted people to focus on there is the financial strength piece. And just when you look at that, one of the things that you should see in it is that, again, there's that nonlinearity where on the left-hand side, right, which would be low financial strength scores, there's sort of a steeper slope to things, right? As your financial strength score gets worse and worse, the output score gets more and more negative more aggressively. And then on the other side, if your financial strength score is good, for stocks that are going kind of higher and higher up on that spectrum of financial strength, we still reward that. We still think that's a good thing for that number to get higher, but the slopes are different on the two sides of that diagram. Getting into negative territory is worse for you from a quality perspective than it is beneficial for you to get higher into the positive territory. So that would be the main thing.
If you were to draw like trend lines on those two above the zero, the trend lines would be different.
That's right. Exactly. Yeah, you would have a different trend line on either side of zero, and that's the important thing that it's capturing there. And then on top of that, you can kind of see how the other factor, we put another factor there for interaction purposes, and you can kind of see how that interfaces with that. It's kind of that concept I was talking about before, where if you simultaneously have very bad net debt and poor financial strength, then the model is going to punish you very severely for that.
So, Joe, we have two standard closing questions. If you could just, so if it's okay, spend a couple more minutes with us.
Sure.
So the first one is, what is the one thing you believe about investing that the majority of your peers would disagree with you on?
Yeah. Well, I would have said about 5 years ago, I would have said the idea that value can work as a part of an investment process was something that we were finding extremely scarce out there. I had some really interesting meetings where I'd be talking to research people at consultant firms or potential clients, and particularly if you had somebody on the opposite side of the table from you who was of a certain age, maybe 30-ish or below, they hadn't seen these cycles. They just didn't. They would, when you said you used value, they would look at you the same way somebody would look at you if you said, I have an astrology component to my factor model, and that, that's a big component to how I pick stocks. They could not grasp how in the world you wanted to use value. As we discussed earlier in the call, I think, some of that has changed now, particularly in international markets, which I think is a good thing. I think one of the things, maybe I'll name a couple things really quickly. One of the things compared to our quant peers, we think it's okay to intervene, right? The quant model is not sacrosanct. It doesn't have all the answers. It's okay to talk to your fundamental colleagues and say, I'm not comfortable with that stock right now. Or to say, you know what, there's something going on politically in this country, maybe in Thailand or India or wherever it might be that you're investing. And you say, maybe I'm normally okay with plus or minus 5% active weight constraints. Let me pull that in a little bit tighter based on what's going on right now. If you intervene too much, you're gonna destroy some things that are good about quant. It is dispassionate. It doesn't get caught up in market moods. It doesn't sort of follow the group think about a lot of things. So you can't intervene too much. But again, when you see a clear-cut case that the quant model is not looking at all of the information or is lacking some context, I do think it makes sense to kind of go in there and be willing to intervene. And I guess the last thing I would say is this isn't so much about peers, but maybe people that we talk to, potential, clients or investors. I think there tends to be this idea, and Jack, I'd be interested to get your perspective on this, that, if a factor is well known in quant and people have known about it for a while, that the efficacy must surely be attenuated and that must be a factor that doesn't work anymore. And in my experience, that is so not true. There are certain factors that I think if they exploit human behavioral weaknesses, things about humans where they just can't help themselves in terms of making that same kind of mistake over and over, those things don't tend to go away. They tend to stick around.
I would agree with you with that. I mean, they're going to have their periods where they struggle like everything else does. but that's not, and there's such a tendency to have these periods where factors struggle and be like, it's over.
It's over.
It's never working again. And
Yeah.
that's just something that's why it's hard to, any type of active thing's hard to do for average investors because of that. Like when it's not working, it's like, all right, let's abandon this and move to the next thing. But I think you're 100% right.
Yeah, and the trick is knowing the difference, right? Maybe there are things, like I said at the beginning of the conversation, we kind of feel like vanilla book to price has probably had its day, and you have to do something a little bit different to make that work. But value in general, there are so many behavioral reasons to expect that humans are not going to change. Human nature isn't going to change. People are going to keep making those same kinds of mistakes, and they'll have their seasons, like you said, but a lot of these things, even if they're known, they're going to continue to work.
And the last question is, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
I think it would be learn to be humble. I think there's, it's hard to make forecasts. I've heard other guests on your show say the same thing. Making forecasts is very difficult. Even if you're really good at it, your hit rate is probably not going to be, it's not going to be 100%. It's not going to be 90. It's probably not going to be 80. You're probably going to be in the 60 to 70% range about being right. And that means you should be humble. We're all out here looking for things that other people have missed, but there are millions of participants in equity markets. They're all looking for that thing that other people missed. And you have to expect sometimes you're the one who's missing something, and you're the one who didn't take all the information into account or didn't properly take context into account. And so does that mean, that you're not confident? No, it's a combination of saying I'm humble, but I'm confident that I have certain skills and I want to make sure those skills have a chance to shine through. And the real answer, the thing that should push you towards is risk management. It should say, given that, you can't always be right about your forecasts, you should be really good at risk management so that you don't allow your risk posture to overwhelm the skill that you do have. And that skill will eventually shine. It will come through if you do your risk management well, and avoid that kind of overconfidence. I mean, I guess the last thing I would say on that subject, and I think you guys know this, financial media does not encourage humility on the part of investors. The guy they want to have on the show is the guy who comes on and says, I know everything. I have all the answers. I'm right about this. I'm pounding the table. And so there are weird, I think, perverse incentives involved in this business, to have this huge level of confidence about every proclamation that you make. And we all know that's not possible. That's not realistic. And so, do what you do, use your skill, manage your risk. And if you do that, I think things are going to work out okay.
Great, Joe. Thank you very much. We appreciate it.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform, or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.